A sudden $6 drop in silver, just like that, from 91 to 85. End of month panic, or something far deeper at play. 3 months in a row, the same pattern, December, January, February. Every single time, silver gets hammered just before futures expire, and yet each time it recovers, rising faster than expected. Registered silver stocks draining from the vaults, physical demand surging in Shanghai. Gold moves up, silver gets knocked down. What does that tell us about who's really controlling the market? Banks, exchanges, and delivery mechanics all converging in the shadows, and buried deep inside a JP Morgan report. A scenario that could redefine silver's floor. If you think this is just another market dip, think again. The full picture will reveal forces that most investors will never see. And the moment that everything changes is closer than you imagine. Welcome to Boring Currency FX. If you haven't subscribed yet, do it now. Think of it as listening to someone who's been through markets for decades, guiding you carefully through every twist. And tell me, where are you watching this from? The streets of New York, a small town in Germany, or somewhere else entirely? Silver just crashed from 91 to 85. $6 gone today. And if you're sitting there watching your portfolio bleed, your first instinct is probably to panic, to sell, to think the rally is over. He needs you to stop. Because what is about to unfold will completely change how this crash is seen. By the end of this briefing, viewers will understand exactly why silver crashed, who benefited, and why this could be one of the most compelling buying opportunities in months. He was going through the data late last night and found something that stopped him in his tracks. The COMEX, the exchange where silver futures trade, halted trading yesterday. They stopped the entire metals market. Gold, silver, copper, natural gas, everything paused mid-session without warning. The explanation offered was technical issues. Analysts are skeptical, and by the time the mechanics are explained, viewers will understand why the reasoning doesn't add up. If you're new here, welcome. This is the hidden economy. We cover silver and gold with raw data, no fluff, no panic. This week's events demand attention. Let's begin. Starting with the pattern, because once seen, it cannot be unseen. In December, the last 2 days of the month, silver traded at $83. Out of nowhere, it crashed to $70. $13 wiped out in 48 hours. No fundamental reason, no supply change, just a sudden violent move before month close. People panicked, people sold. Then, January began, silver recovered everything, surged to 121, the all-time high, and then, in the final 48 hours, dropped to 70 again. A 42% drop in days. Messages flooded in from investors swearing off silver forever. February arrived, silver rose back to 91, only to drop $6 on the last day. 3 consecutive months, the same final day shock, all near futures expiration. Once is random, twice is suspicious. 3 times, it signals a pattern. And when patterns this clean emerge, the focus shifts from price to incentives. Somebody gains when silver drops $6 in a single session. Short sellers profit. Those needing to deliver silver at expiration benefit because the metal owed becomes cheaper. Even the exchange itself gains. Lower prices reduce delivery demand. Over the last 3 months, demand for physical metal surged. In February alone, 24.8 million ounces were moved. Registered silver at the COMEX dropped from over 150 million ounces to 87 million. Vaults are lighter every month. End of month, more buyers want delivery than sellers can provide. This isn't a price crisis, it's a logistics crisis. Every buyer needs a seller. When numbers don't align, the exchange steps in. Yesterday, the CME halted all metals trading during this critical moment. Technical issues, they said, but historical precedent shows metals halts during expiration week are extremely rare, and the systemic nature of this halt suggests pressure beyond one contract. Behind closed doors, orders are matched, buyers persuaded to roll contracts forward, patient participants promised delivery next month. By the time trading resumes, the buying pressure has evaporated. Sellers dominate and price drops hard. This is not conspiracy. It is market mechanics. Futures exchanges are designed to maintain order. When buyer demand exceeds available supply, the resulting crash is engineered to prevent systemic failure, a cooling mechanism rather than a natural sell-off. Even as silver dipped, gold remained stable or even rallied. Normally, gold and silver move together. Divergent signals targeted pressure. Silver is the metal with delivery problems. Registered inventory falling from 102 million to 87 million in 2 weeks. Wells Fargo delivered 228 contracts in 1 day. Gold did not face such pressure, so silver bore the brunt. And the pressure is building. Patterns repeat. Registered inventory shrinks. Physical demand persists in Shanghai, trading above $100. The numbers tell a story the price alone cannot. This is why the crash from 91 to 85 should not trigger panic. It is part of a larger structural cycle. And when examined in full, the systemic forces behind silver are far more revealing than daily price swings. Most investors remember dramatic crashes. Very few study repetition. What made the recent silver decline unusual was not its size. A $6 drop is not historic in percentage terms. What made it significant was its position in time. It happened at the end of the month, and it was not alone. In December, silver fell sharply in the final trading days before the calendar turned. In January, the same behavior appeared again, a steep decline just before month close and contract transition. In February, once again, pressure intensified in the final window before expiration. 3 months, same timing, similar structure. For casual observers, each drop felt independent. For structural analysts, repetition removes randomness. When an event repeats at the same point in a cycle, attention shifts from emotion to incentives. Futures markets operate on calendars, contracts expire, positions must be rolled or delivered, margin requirements are recalculated, books are closed, risk managers report exposures, funds adjust leverage. The end of the month is not just a date, it is an accounting event. Institutional desks reduce risk into reporting periods. Leverage traders reassess collateral. Clearing firms examine exposure. Any contract that moves too aggressively into expiration week creates operational stress. In this environment, price volatility is not only about supply and demand, it is about balance sheet management. Consider what happens when silver rallies strongly into expiration. More participants hold profitable long contracts. If they choose delivery, sellers must supply metal. If they roll, liquidity must absorb the transfer. But if price rises too quickly into expiration, delivery demand can accelerate. That is where velocity becomes important. A slow climb from 80 to 90 over several months allows the system to adjust. Inventory flows gradually. Hedging adapts, participants prepare. A sharp acceleration within days compresses time. It forces decisions faster than the system prefers. When reviewing the 3-month pattern, one observation stands out. The magnitude of the late-month drops has been decreasing. The first decline was deep, the second was dramatic, the third was smaller. In market structure terms, that suggests absorption. Absorption occurs when buyers step in earlier during pullbacks. Instead of waiting for extreme discounts, they accumulate at higher levels. Each successive low forms above the previous one. That creates a rising floor. If December found support near 70 and February found support near 85, the difference is not minor. It signals that demand is entering sooner. Patterns like this matter to entrepreneurs who track commodities as indicators of economic stress. Silver is not only a speculative asset, it is an input in electronics, solar panels, medical equipment, and advanced manufacturing. When price declines fail to return to prior lows despite aggressive selling pressure, it often reflects underlying demand strength. The correlation with gold adds another layer. During these late-month declines, gold did not mirror silver's weakness to the same degree. In some sessions, gold recovered while silver remained suppressed. Divergence between correlated assets often reveals localized pressure rather than broad macro fear. If both metals were falling together due to global risk aversion, the interpretation would be simple. Capital is exiting precious metals. But when gold stabilizes and silver absorbs disproportionate pressure near expiration, the cause likely lies within silver's own contract dynamics. Another element deserves attention: open interest behavior. When open interest remains elevated into delivery windows, it increases the probability of forced positioning adjustments. Traders who expected to exit earlier may be compelled to close quickly. Funds managing leverage may reduce exposure before reporting deadlines. These mechanical adjustments often occur regardless of long-term fundamentals. For decision makers, the lesson is practical. Markets are not only shaped by belief, they are shaped by structure. A recurring pattern at the end of each month suggests that institutional processes, not retail emotion, are influencing price behavior. This does not imply manipulation, it implies design. Futures markets were created to manage risk for producers and consumers. Their structure favors stability over sudden imbalance. When stress rises near expiration, cooling mechanisms often appear in the form of volatility spikes or controlled pullbacks. The important observation is this: after each late-month decline, silver recovered. Recovery does not prove inevitability, but it demonstrates resilience. Resilient markets under repeated structural stress often indicate tightening supply or strengthening demand beneath the surface. If the pattern continues, entrepreneurs and capital allocators must consider two scenarios. First, the resets continue indefinitely, volatility without breakout. Second, at some point the system fails to suppress acceleration because physical demand overrides calendar management. The second scenario is rarer, but it is precisely how commodity repricing cycles begin. 3 months of synchronized late-cycle weakness followed by recovery is not random noise. It is a behavioral signature, and behavioral signatures in markets tend to precede structural change. The question is not whether silver can fall again at month end. The more strategic question is what happens the first month it does not. Price attracts attention. Inventory determines outcome. While headlines focused on silver's drop from 91 to 85, a quieter shift was happening inside vault reports. The numbers were not dramatic in a single day, but over weeks, they revealed a steady trend. Registered silver stocks were declining. To understand why that matters, one must understand the difference between eligible and registered metal inside the COMEX warehouse system. Eligible silver is metal that meets exchange standards but is not committed for delivery. It belongs to private owners who may not intend to sell. Registered silver is different. It is available for immediate delivery against futures contracts. It is the working inventory of the system. When registered inventory falls, the buffer thins. In recent weeks, millions of ounces have moved out of the registered category. Some metal leaves the vault entirely, some is reclassified. Either way, the amount available to satisfy contract holders declines. At the same time, global demand signals remain firm. In Asia, silver has traded at a premium compared to international spot prices. Premiums exist for one reason: local demand exceeds local supply. Buyers are willing to pay more to secure physical metal. When such premiums persist, they create arbitrage pressure. Traders move metal toward higher paying markets. Over time, that movement drains supply from lower premium exchanges. For business leaders, this is not a theoretical discussion, it is supply chain mathematics. The world consumes more silver annually than it mines. Industrial applications continue to expand. Solar energy installations require silver paste. Electric vehicles use silver in electronics. Medical and technological uses grow incrementally each year. Mine supply does not adjust quickly. Bringing new production online requires years of permitting, capital investment, and infrastructure development. This creates a structural deficit. Deficits do not cause price spikes immediately. They cause tightening. Tightening increases sensitivity. Sensitivity increases volatility. Now, consider delivery notices. When a futures contract reaches expiration and a holder stands for delivery, the exchange assigns a seller. Metal moves from registered stock to the buyer. If delivery volume rises while registered inventory falls, the ratio between available supply and contractual demand compresses. Compression changes behavior. Sellers become cautious. Buyers become assertive. Volatility rises around expiration dates. Institutional banks also participate in delivery cycles. When large financial institutions either deliver or receive significant volumes in short time frames, it signals strategic positioning rather than retail speculation. It is important to remain analytical here. Declining inventory alone does not guarantee a shortage. Warehouses still contain significant silver. Markets are not at zero supply, but the direction of change matters more than the absolute level. If registered stocks trend lower for months while industrial demand remains steady or rises, the cushion shrinks. Each expiration cycle then becomes more sensitive than the previous one. Entrepreneurs should view this as a systems problem. Imagine a manufacturer operating with declining raw material reserves while orders remain stable. Even if production continues normally, risk increases. Any unexpected surge in demand or disruption in supply creates outsized impact. Commodity exchanges function similarly. Another important factor is investor psychology. As inventory data becomes widely known, expectations shift. Participants who believe supply is tightening may choose to take delivery rather than roll contracts. That behavior accelerates the drain. The market can then enter a feedback loop. Tightening supply increases delivery demand, which further tightens supply. However, such loops require confirmation. They require consistent data. So far, the data shows declining registered stocks and repeated end-of-month volatility. It does not yet show system failure. For capital allocators, the prudent approach is conditional thinking. If inventory stabilizes and premiums fade, recent volatility may simply reflect temporary repositioning. If inventory continues declining while premiums remain elevated, the probability of structural repricing increases. In commodity history, sustained inventory drawdowns often precede price breakouts, not because of emotion, but because of arithmetic. When supply buffers shrink below comfort levels, markets must adjust price upward to ration demand. This adjustment does not occur gradually. It occurs when stress exceeds tolerance. Silver sits at that intersection, between industrial necessity and financial hedging, between paper contracts and physical ounces. The vault numbers may not trend on social media. They do not create excitement, but they are measurable, verifiable indicators of structural tension. For serious decision makers, that makes them more important than daily price swings. If silver's recent volatility is driven by tightening physical supply, then the market is not weakening, it is compressing. And compression in commodity markets rarely resolves quietly. While traders debated charts and short-term volatility, a more important signal emerged quietly from the institutional side of the market. It did not come from social media. It did not come from retail speculation. It came from a research scenario published by J.P. Morgan. Inside a broader commodities note, analysts modeled potential equilibrium prices for gold under different monetary stress conditions. The projected range extended far above current levels. It was not presented as a prediction. It was presented as a scenario analysis, a structured evaluation of what gold might require to balance sovereign debt expansion and currency dilution. To the casual reader, it was theoretical. To serious capital allocators, it was strategic signaling. Large banks do not publish extreme price ranges without internal modeling support. They evaluate fiscal trajectories, central bank balance sheets, real interest rate trends, and global reserve diversification flows. Their scenario work is not emotional. It is mathematical. The key insight was not the exact gold number. The key insight was what such a range implies for silver. Silver historically trades in a ratio relationship with gold. The gold to silver ratio fluctuates, but it remains one of the most stable long-term comparative metrics in precious metals. If gold establishes a structurally higher base price due to monetary pressures, silver's floor also rises. Floor modeling is different from target forecasting. A target assumes upside potential. A floor defines downside probability. If institutional research implies that gold equilibrium pricing sits materially above historical norms, then silver's long-term downside becomes more limited under the same macro assumptions. For entrepreneurs and business leaders, this distinction matters. Markets reprice in stages. First, institutions model risk. Second, they adjust positioning. Third, public narratives catch up. By the time headlines reflect structural change, positioning is often already underway. If gold were to stabilize at significantly higher levels over time, the traditional gold to silver ratio would compress silver volatility into higher trading bands. This does not guarantee an immediate surge. It does not eliminate corrections, but it changes risk asymmetry. Consider two scenarios. In the first, gold remains capped and monetary stress eases, silver volatility continues, but structural repricing fades. In the second, gold gradually establishes a higher equilibrium due to persistent fiscal deficits, currency debasement concerns, or reserve diversification. In that environment, silver's valuation recalibrates upward, even if the ratio remains conservative. The JP Morgan scenario analysis suggests institutions are at least preparing for the second outcome. Preparation is not hype. It is risk management. Another important layer is positioning behavior. Large financial institutions often publish research aligned with broader portfolio strategy. When they model higher equilibrium outcomes, they are not merely speculating, they are stress testing exposure. Stress testing at higher price bands implies that those bands are plausible enough to require capital planning. For silver, this becomes critical when combined with the physical inventory trends discussed earlier. If physical supply tightens while monetary modeling raises gold's equilibrium baseline, silver sits at the intersection of two upward pressures: industrial deficit and monetary repricing. That intersection is rare. Most commodities are driven primarily by industrial cycles. Precious metals are driven primarily by monetary cycles. Silver straddles both. For strategic capital allocators, this dual identity creates opportunity, but also complexity. One must ask, what would invalidate this thesis? Several factors could reduce upward pressure. First, aggressive interest rate tightening that strengthens real yield significantly. Higher real yields often suppress precious metals demand. Second, a sharp global slowdown, reducing industrial silver consumption. Third, stabilization in fiscal deficits and credible monetary discipline from major economies. At present, none of these factors have fully materialized in a sustained way. Instead, fiscal deficits remain elevated. Sovereign debt levels continue expanding. Central banks maintain delicate balances between growth and inflation control. In such an environment, institutional modeling naturally expands its upper range scenarios. The critical question is timing. Markets do not move because reports are published. They move when structural conditions align. Silver's repeated end-of-month volatility, declining registered inventories, and institutional equilibrium modeling are separate data points. Together, they form a framework. The framework suggests that recent price weakness may represent structural cooling rather than long-term reversal. For entrepreneurs building businesses in uncertain monetary environments, silver should not be viewed as a trade. It should be viewed as a signal. If silver breaks and sustains higher resistance levels while inventory continues tightening and institutional modeling remains elevated, the repricing phase accelerates. If silver fails to hold higher floors and inventory stabilizes, the thesis weakens. Serious decision makers operate in probabilities, not certainties. The JP Morgan report does not guarantee a final surge, but it changes the downside math. And in capital allocation, when downside compresses while structural pressures build, attention shifts. Because in commodity markets, equilibrium is rarely found at the midpoint. It is found where supply, structure, and monetary reality can no longer be ignored.